Ever wondered how much you can truly trust the numbers you see? Especially when it comes to those, huge reports from big corporations.
Hmm.
We all put a lot of faith in information, right? News reports, product reviews, financial statements. But how do we really know what's presented is accurate and genuinely free from hidden issues?
It's a fundamental thing, isn't it? This
Yeah.
need for verification. Think
Yeah.
about your own life.
Hmm.
You glance at the nutrition label on your cereal, or maybe you're looking at the fine print on a car lease, or trying to make sense of your retirement fund statement.
Right.
There's this unspoken expectation that someone, somewhere, has checked these numbers. Someone needs to make sure what's presented isn't just, well, plausible, but genuinely true and transparent.
And today, we're pulling back the curtain on a cornerstone of that financial trust. It's something called audit risk.
Mm.
Now, this isn't just some dry accounting term. It's a concept that impacts, well, pretty much everything, from where people decide to invest their hard-earned money to
Mm.
the overall stability of our economy. It's all about the potential pitfalls, the things that could go wrong when independent auditors are meticulously scrutinizing a company's books.
Yeah.
So our mission today is to really unpack what audit risk means, explore its different kind of interconnected components, and see how these expert guides, the auditors, navigate this incredibly complex landscape
Right.
to ultimately give us, the users of financial statements, a reliable basis to trust those numbers.
And we'll be drawing insights from a comprehensive look at the world of auditing, specifically diving deep into this concept of audit risk.
Okay.
Our goal is to make these intricate ideas clear, accessible, understandable,
Yeah.
to give you a genuine shortcut to being well-informed about a critical aspect of financial integrity,
Yeah.
and hopefully provide a few aha moments along the way.
Love those aha moments. So let's dive straight in. We're talking about audit risk. What's the very core definition here, the absolute starting point?
Okay, at its most fundamental level, audit risk is simply the risk that an auditor might unknowingly fail to correctly modify their opinion on financial statements that are materially misstated.
Unknowingly fail. That sounds key.
It's absolutely crucial. This isn't about intentional misconduct or an auditor trying to deliberately hide something. No.
Okay.
Instead, it speaks to genuine oversight, maybe an undetected issue, or perhaps a misjudgment during the audit process itself.
Hmm.
That leads to the auditor expressing an opinion that the financial statements are clean, presented fairly in all material respects, when in fact they contain significant, impactful errors.
So it's the risk something just slips through the cracks.
Exactly. Despite their professional diligence, it's the risk something important gets missed.
That distinction, that it's unknowingly missing something, is really important. But it brings up a big question. Why does this risk even exist? Why can't auditors just, guarantee everything is 100% perfect down to the last cent?
That's a really perceptive question,
Oh.
and it gets right to the heart of the auditing profession.
Yeah.
It comes down to this concept of reasonable assurance, not absolute assurance.
Reasonable, not absolute.
Auditors are required to obtain reasonable assurance about whether the financial statements are free of material misstatement. Think of it like this.
Okay.
If you go to a doctor for a checkup, a really comprehensive one, they run tests, ask questions, use their expertise.
Right.
They get a reasonable assurance about your health. They can tell you if you're generally healthy or if there are specific issues.
Makes sense.
But they can't give you absolute assurance unless they could, examine every single cell in your body microscopically.
Which is impossible.
Right. Impractical, astronomically expensive, just impossible. The same principle applies to an audit.
Ah, okay.
It's simply not feasible to check every single transaction, every invoice, every calculation in a huge multi-billion-dollar company with millions, maybe billions of data points.
Just too much.
Exactly. This inherent practical limitation is precisely why audit risk is a fundamental and, frankly, unavoidable concept in the profession.
So the audit isn't a guarantee of perfection.
No, it's a highly skilled, systematic assessment designed to minimize the risk of material error, but not eliminate it entirely.
That doctor analogy really helps. So because of this limitation, audit risk is always there. It's a reality. But the auditor's job is to get it down low enough.
Precisely. Before an auditor can confidently express their opinion on the financial statements, they must reduce that overall audit risk to an appropriately low level.
Appropriately low, that's the threshold.
It's a critical threshold. Auditors relentlessly strive to meet it, ensuring their final opinion carries the weight of a thorough, diligent, and professionally sound process. It's the point where they can really stand behind their work.
Okay, now a key term we've already used a few times is material misstatement. This sounds like the core problem auditors are trying not to miss. What exactly makes a misstatement material? How big does an error have to be?
Right? Material. It's formally defined as an omission or misstatement of accounting information that, in light of surrounding circumstances, makes it probable that the judgment of a reasonable person relying on the information would have been changed or influenced.
Okay, let's break that down. Who's this reasonable person?
Good question. We're talking about the key decision makers. Investors deciding whether to buy or sell stock.
Yeah.
Creditors deciding whether to lend money. Regulators ensuring compliance. Those kinds of people.
Got it. So the key is the impact.
Exactly. The impact. It's not just a small typo or a tiny rounding error.
Yeah.
It's something significant enough that if it were known and corrected, it would genuinely alter a major financial decision or evaluation for those people relying on the statements.
So it's about whether the error would actually mislead someone into making a different financial choice. That makes a lot of sense. And these misstatements, they can come from different places, right?
Yeah.
Are they always just accidents?
Oh, not at all. Misstatements can arise from two very distinct main sources: errors and fraud.
Errors and fraud. Okay.
Errors are fundamentally unintentional mistakes. Simple calculation errors, maybe transposing numbers, data entry mistakes like typing 1,000 instead of 10,000, or even just an honest misinterpretation of a complex accounting rule. No intent to deceive.
That's a mistake.
Right.
All right.
Fraud, on the other hand, is entirely intentional. This involves deliberate manipulation of numbers.
Like cooking the books.
Exactly. Recording fictitious sales, intentionally hiding crucial information like undisclosed debts, or even outright theft of company assets.
Wow.
Both errors and fraud can lead to material misstatements, and a key part of an auditor's role is to be diligently looking for indicators of both. Understanding, of course, that how you look for them will differ.
That makes sense. It sounds like a pretty broad category then, given all the ways numbers can be wrong. Can you give us a more extensive rundown, kind of a laundry list, of how these misstatements can actually show up in financial statements?
Absolutely. And the list is quite comprehensive, which really shows the many ways, subtle and not so subtle, that financial figures can go awry. Misstatements can include inaccuracies in data collection or processing, simple human errors, system glitches. Maybe a transaction gets recorded in the wrong account, or a database puts in the wrong default value.
Right.
Departures from generally accepted accounting principles,
Yeah.
JA, or IFRS internationally.
Those are the rules of the road, basically.
Exactly, the established rules for financial reporting. If a company deviates from these rules without proper justification, like recognizing revenue too early or improperly valuing inventory, that's a misstatement. It's like breaking a fundamental rule of the game.
Okay.
Omissions. This is when crucial information is just left out entirely. Maybe failing to disclose a major pending lawsuit that could have a huge impact.
That seems big.
It can be. Then there are incorrect estimates or judgments. Lots of financial figures rely on management's best estimates because absolute certainty isn't always possible.
Like guessing how long a machine will last.
Precisely. That affects depreciation, or how much customer debt they expect not to collect, or the fair value of complex investments. If these estimates are unreasonable, biased, or just not based on good evidence compared to, say, industry norms, they can lead to significant misstatements.
Judgment calls.
Very much so. Also, inappropriate selection or application of accounting policies. Companies sometimes have choices within GAAP. But if they pick a policy that isn't really suitable for their situation or apply it incorrectly, it can distort the picture.
Okay.
And finally, inappropriate classification, aggregation, or disaggregation of information. This is about how things are grouped or separated. Lumping dissimilar items together like operating and non-operating expenses without clear disclosure, or maybe splitting up related items that really should be presented as one. These can make it really hard for a user to understand what's actually going on financially.
That really covers a wide spectrum, and it's the auditor's job to figure out if these issues, maybe even a bunch of small ones added together, become material to someone reading the statements.
Exactly right. The auditor has to exercise significant professional judgment. They need to determine what level of misstatement, either on its own or combined with others, would be considered material to that reasonable financial statement user.
And it's not a fixed number.
No, it's a dynamic and critical judgment call. It directly impacts the scope of their audit work, the nature, timing, and extent. It tells them how much they need to dig and where to focus their energy.
Now, you mentioned a few specific types earlier, factual, judgmental, and projected misstatements. Can you elaborate on those? Maybe give us some clear examples to nail those down.
Certainly, understanding these types help auditors categorize and approach them properly.
Okay.
First, factual misstatements. These are the straightforward ones. There's really no doubt once you see the evidence. Objectively incorrect.
Like a typo.
Could be. A data entry error where $10,000 was recorded as $1,000. Or a clear math mistake summing up an invoice. These are usually easy to spot, quantify, and get corrected once found.
Okay, that's clear. What about judgmental?
Judgmental misstatements. These are much more nuanced. They come from differences in judgment between management and the auditor, especially around things like recognizing revenue, measuring assets, presenting information or disclosures. Or maybe the auditor thinks management's chosen accounting policy is just unreasonable or inappropriate.
Can you give an example?
Sure. Let's say a company has a big piece of manufacturing equipment. Management estimates its useful life at 20 years for depreciation.
Okay.
But the auditor looks at industry data, the machine's actual wear and tear, maybe technology trends, and believes 10 years is much more reasonable.
So that changes the expense each year.
Exactly. That difference in judgment directly leads to a different depreciation expense, which hits net income and the asset's value on the books. It's not necessarily fraud, but the estimate might be overly optimistic or just not well supported in the auditor's view.
I see. And the last one? Projected.
Projected misstatements. These are the auditor's best estimate of misstatements in an entire population based on errors they find in an audit sample.
Because they can't check everything.
Right, they sample. So if an auditor samples, say, 100 sales invoices out of 10,000 total,
Right.
and finds 2 where revenue was recognized incorrectly, they'll project that 2% error rate across all 10,000 invoices.
So they estimate the total error.
Exactly. That projection becomes their best estimate of the total misstatement in that account. But remember, it's an estimate, a statistical inference, not a precise count. It has its own uncertainty built in.
That clarifies the different flavors of misstatement really well. So with all these potential issues floating around, how do auditors systematically approach this whole audit risk problem? Is there like a model they use to manage it all?
Yes, absolutely. And it's an incredibly powerful conceptual framework that guides pretty much every audit. It's called the audit risk model.
Okay, the audit risk model.
And its fundamental equation is AR, RMMX, DR.
AR equals RMM times DIR.
Right. Audit risk equals the risk of material misstatement multiplied by detection risk. Think of this model as the auditor's dashboard for managing uncertainty. It helps them strategically allocate their efforts.
Okay, let's break down those components for us. AR, RMM, DIR.
Sure. First, audit risk, AR. That's the overall risk we started with. The chance the auditor unknowingly messes up their opinion on misstated financials.
The one they need to keep low.
Exactly. They must reduce this to an appropriately low level. It represents the maximum uncertainty the audit firm is willing to accept for that specific audit.
Okay, AR. Got it. Next.
Second, risk of material misstatement, RMM. This is the inherent likelihood that the financial statements themselves contain material errors before the auditor even started their detailed work.
So this is risk in the company.
Yes, it resides within the client company and its environment. The auditor's job is to assess this risk. They don't control it directly.
Assess, not control. Okay, RMM. And the last one.
Third, detection risk, DR. This is the risk that the auditor's own procedures, the tests and analyses they perform, will fail to detect a material misstatement that already exists in the financials.
So this is the auditor's risk. The risk their work won't catch the error.
Precisely. This is the one component the auditor directly controls through how they design and execute their audit plan.
So if the company's financials are already really risky, high RMM, the auditor has to make sure their own procedures are super effective, low DR, to compensate. That makes intuitive sense.
You've got it. And this model isn't necessarily a strict mathematical formula where you plug in numbers and get a precise percentage output.
It's more conceptual.
Primarily, yes. While components can be assessed quantitatively, maybe as a percentage, they're often assessed non-quantitatively, using terms like high, medium, or low.
Okay.
It's mainly a systematic way for auditors to think about, categorize, and strategically respond to the different risks they face. It helps them prioritize where to spend their time and resources.
Let's dig deeper into that risk of material misstatement, RMM. You said it's a combination of two other risks.
Yes, absolutely. RMM itself is a product of two key components: inherent risk, IR, and control risk, CR.
IR and CR.
Okay, if you could think of the full audit risk model equation as AR x IR, IR x CR x DR.
Got the whole family now.
Right. The auditor assesses RMM by doing what are called risk assessment procedures, understanding the client's business, its industry, its environment,
Uh-huh.
and, where appropriate, doing tests of controls to see how effective the client's internal safeguards are.
Okay.
A significant risk of material misstatement exists when there's a reasonable possibility of misstatement happening. That's the likelihood, and if it did happen, a reasonable possibility of it being material is the magnitude.
Likelihood and magnitude.
Crucially, for any risks they identify, the auditor performs a separate assessment of both inherent risk and control risk. They look at them individually first.
Okay, let's unpack inherent risk first. IR. What makes something inherently susceptible to being misstated? What's this built-in vulnerability you mentioned?
Inherent risk, IR, is the susceptibility of an assertion that a claim management makes about their numbers.
Like, this cash exists.
Exactly. That cash exists, they own it, it's valued correctly. It's the susceptibility of that assertion to a material misstatement before considering any related internal control.
Before controls, okay.
Think of it like how prone is something to breaking before you put on protective gear or install security systems. It's about the very nature of the item itself.
So some accounts or transactions are just naturally riskier than others, no matter what the company does to protect them.
Precisely. The factors contributing to inherent risk are characteristics of the accounts, transactions, or conditions themselves. These factors can be qualitative, like complexity or subjectivity, or quantitative, like just the sheer volume of transactions. They include things like complexity. How intricate is the accounting? Valuing complex derivatives is inherently more complex, thus riskier, than just counting cash.
Right.
Subjectivity, how much judgment is involved. Estimating warranty liabilities or bad debts requires significant subjective judgment, making them more susceptible to error.
Okay.
Change. Is the business or industry evolving rapidly? New tech, shifting markets, new accounting rules, they all introduce uncertainty and raise risk.
Makes sense.
Uncertainty. How certain are future outcomes that affect current accounting, like the outcome of a big lawsuit or whether a large loan will be repaid?
Yeah, that's uncertain.
Susceptibility to management bias. Some areas are just more tempting for management to, let's say, manage earnings. Aggressive revenue recognition, overly optimistic estimates. That human element inherently raises risk.
So it's not just high or low risk, it's more like a scale.
That's a crucial insight.
Right.
Yes, inherent risk isn't binary. It varies on a continuous scale, often called the spectrum of inherent risk.
Spectrum, okay.
This helps auditors gauge the significance of both the likelihood of a misstatement happening and its potential magnitude. An account with tons of complex, unique transactions in a fast-changing industry will be way up high on that spectrum compared to, say, a simple, stable, petty cash fund.
Can you give us some really concrete examples? What are some red flags that scream high inherent risk to an auditor?
Absolutely. Several factors usually point to high inherent risk and act as immediate flags. High volume, unique, or individually significant transactions. Think retail, millions of small credit card swipes, daily sheer volume increases error risk.
Yeah.
Or a company making a huge one-off complex acquisition of a foreign competitor. That unique deal is inherently risky compared to routine stuff.
Okay.
Complex or subjective calculations. Valuing exotic financial instruments or the math behind pension liabilities for thousands of employees requires specialists, lots of judgment, high risk. Amounts derived from estimates. We touched on this. Useful life of assets. Warranty accruals. Fair value of certain investments. All based on future predictions and judgment. Very high risk. A small change in assumption can have a big impact.
Estimates are always tricky.
They are. And cash. Almost always high inherent risk. It's liquid, easy to move, hard to trace without good controls. Susceptible to theft, manipulation.
Makes sense.
And beyond specific accounts, broader things can raise inherent risk for the whole company.
Like what?
Technology rendering a product obsolete. If you make widgets and someone invents a super widget, your inventory value could tank. High risk for inventory valuation.
Ouch.
Lack of working capital or significant debt. Financial stress. Pressure on management to fudge the numbers to get loans or meet targets. Increases fraud risk inherently. Decline in the overall industry or economy. Downturns impact revenue, collections, asset values, maybe even the company's ability to keep going. Increases risk across the board.
Right.
Even broader business risks identified during planning a new competitor, supply chain chaos. New regulations can indirectly increase inherent risk by creating financial pressure. Conversely, If an account isn't likely to have a material misstatement, inherent risk would be assessed low.
That paints a really clear picture of inherent risk. It's about the what's of the business, its environment. So, what about control risk, CR? How does that fit into RMM and what's it about?
Control risk is the second piece of RMM. It's the risk that a material misstatement that could occur in an assertion that inherent susceptibility we just discussed will not be prevented or detected and corrected in a timely manner by the company's own internal control system.
Ah, okay. So if inherent risk is about the potential break, control risk is about whether the company's alarm system and guards work.
That's a great analogy. Exactly. Control risk is a direct function of how effective those internal controls are, their design, and their operation. A good system aims to reduce error and fraud risk.
But no system's perfect, right?
Critically important point. Some amount of control risk always exists because of the inherent limitations of any internal control system.
Why is that?
Well, factors like human error. People make mistakes, forget steps, misunderstand things.
Yep.
Management override. Senior managers can sometimes just bypass controls if they're determined to manipulate things. Very tough to detect.
Sneaky.
And collusion. Two or more people working together can often get around controls designed for individuals acting alone.
So given these limitations, when would an auditor typically assess control risk as high? What tells them the company's safeguards are weak?
They'd assess CR as high in a few key situations. First, absence of effective controls. Just no controls for a specific assertion, like no one reconciles the bank account, a clear gap.
Okay.
Second, implemented controls aren't operating effectively. Controls exist on paper, maybe designed okay, but people aren't following them, or they just don't work right in practice, like needing two signatures, but the second person just signs without looking.
Happens all the time, I bet.
It does. Third, the auditor strategically decides not to test controls. Sometimes it's just more efficient not to. Maybe testing costs too much, or inherent risk is already so high, they know they need tons of direct testing anyway.
So they just assume the controls don't work for their purposes.
Effectively, yes. They set control risk at its maximum level in that case. They don't rely on the client's controls to reduce their own work.
So if they assess control risk at the maximum, what happens to RMM? Does that simplify things?
Yes, it does simplify the equation in a way. When control risk is assessed at maximum, the risk of material misstatement, RMM, becomes equal to just the inherent risk, IR.
RMMIR.
Right. Because the auditor is saying we can't rely on the client's controls, so the only risk left from the client side is the inherent risk. It tells the auditor, don't count on their system, you need to find the errors yourself.
Makes sense.
But even if they don't plan to rely on controls, just understanding their design and implementation is still valuable. It helps them design better direct tests later on.
This feels like a good spot for one of those passkey insights, that IR and CR are independent of the audit itself.
Absolutely. That's a crucial passkey. Inherent risk and control risk exist whether an audit happens or not. The auditor generally cannot change these risks. They're part of the client's business and environment.
The auditor is a diagnostician, not a fixer in that sense.
Exactly. They diagnose the risk. They don't cause it or inherently reduce it. However, and this is vital, the auditor can and will change their assessment of these risks as the audit progresses and they learn more.
Their understanding evolves.
Precisely. That dynamic assessment is key.
Okay, so auditors assess RMM, IR times CR. That's what they find. But then there's a detection risk, DR, which is squarely on the auditor and the one they can actually influence.
Exactly right. Detection risk is the risk that the auditor's own procedures, their tests, analyses, verification steps, will fail to detect a material misstatement that already exists in an assertion.
So if IR is the susceptibility and CR is the failure of the company's guards, DR is the risk the auditor's own security team misses the issue.
Perfect analogy. Despite all their diligent checks, the auditor might simply miss something lurking in the financials. That's detection risk.
Why would they miss something, though? With all the training and tech, you'd think they'd catch everything.
It's a fair question, and it gets back to practical realities. Some detection risk always exists for a couple of main reasons. First, auditors don't usually examine 100% of anything.
Sampling again.
Right. It's inefficient and too costly. They sample. And there's always a statistical risk. The sample isn't perfectly representative. An error could be in the part they didn't look at.
Okay.
Second, auditors are human. Despite expertise, they can make mistakes applying procedures, misinterpret results, overlook subtle clues.
Right.
That's why robust quality control, training, and professional skepticism are so incredibly important in audit firms. Detection risk can even be broken down further. like risk from specific detailed tests versus risk from broader analytical procedures. Both can fail sometimes.
So, with all these risks inherent, control, detection, how does the auditor put it all together to manage the audit effectively and give us a reliable opinion?
This is where their overall professional judgment and control really matter. The auditor's assessment of the overall risk level drives key decisions.
Like what?
Like staffing a higher risk audit might get more experienced auditors,
Okay.
supervisions, more oversight from senior partners, and crucially, the scope of the audit, what and how much to test. Higher risk means broader scope, more testing.
So just to recap that critical point, auditors assess IR and CR, they find those, but they only control DR, their own risk of missing something. That's their main lever.
That is precisely the crucial takeaway. They use
Okay.
judgment to assess all components, but they only control detection risk. That's their operational lever.
Okay.
They use their assessment of RMM, that IR times CR, to figure out the appropriate level of DR they can accept.
Yeah.
And it's not static. As the audit goes on, they gather evidence, maybe find unexpected things.
Yeah.
They have to continuously evaluate if the evidence is sufficient. If not, they perform more procedures. It's dynamic, iterative.
Now, here's where it gets really interesting for me. This core inverse relationship between RMM and DOCR. Explain that it feels like the heart of the model strategy.
It really is a cornerstone concept, and it's where the audit strategy comes alive. It works like this.
Okay.
When the risk of material misstatement, RMM equals IRXCR, is high, meaning the financials are likely already misstated due to risky business or weak controls.
Right.
The auditor must set the acceptable detection risk, DR, at a low level.
Yeah.
They have to work extra hard not to miss those likely misstatements. Their own procedures must be incredibly effective.
Makes total sense. And the opposite.
Conversely, when RMM is low,
Mm-hmm.
meaning the financials are unlikely to be misstated, stable business, strong controls,
Uh-huh.
the auditor can justify a higher detection risk, DR. They don't need their own procedures to be quite as stringent or exhaustive because the starting risk is lower.
So let me try the umbrella analogy again. High risk of rain, high RMM. You need a really good, effective umbrella. Low DR, low risk of rain, low RMM. Maybe a less effective, smaller umbrella is okay, higher DR.
That captures the essence perfectly. The effectiveness of the umbrella, the audit procedures is directly adjusted based on the assessed risk from the environment, the RMM.
Love it. So how exactly does the auditor control that detection risk? What specific actions do they take to make their umbrella more or less effective?
That's the key operational part. The acceptable level of DR directly dictates the nature, extent, and timing of their audit procedures. This is how they pull that control lever.
Nature, extent, timing. Okay.
To ensure a low level of detection risk when RMM is high, they need to significantly increase the persuasiveness and reliability of their evidence. This means
Okay.
changing the nature of substantive tests, shifting from less effective to more effective procedures. Instead of just looking at internal documents, they might directly confirm balances with outside parties.
Like banks or customers.
Exactly. Banks for cash, customers for receivables, lawyers for lawsuits. External independent evidence is much stronger.
Got it. What else?
Changing the extent of substantive tests, dramatically increase the amount of testing, use much larger sample sizes, look at more transactions, dig into more details, test 200 invoices instead of 50, for example?
More work.
Definitely. And changing the timing of substantive tests. Perform procedures closer to the client's year-end, or right at year-end.
Why does timing matter?
Because testing at, say, December 31st gives more relevant evidence for the balance sheet date itself. Less risk of big changes happening between an earlier test date and year-end, especially for volatile accounts.
Ah, okay. Nature, extent, timing. That's how they lower DR. And if DR can be higher.
If the acceptable DR is higher because RMM is low, the assurance needed from their substantive tests decreases. So they can,
relax a bit.
in a measured way, yes. They might use somewhat less persuasive evidence, maybe rely more on internal stuff. They can reduce the extent of testing smaller sample sizes. And they can perform more testing on an interim basis, do more work before year-end, which is often more efficient.
But even if everything looks great internally, RMM is low, controls are fantastic, auditors still always have to do substantive procedures, right? That feels like a bottom line.
That's absolutely critical. It's a non-negotiable safeguard in auditing standards. Even when assessed control risk is very low, substantive procedures are always necessary for each relevant assertion related to significant transaction classes, account balances, and disclosures.
Why? If controls are great.
Because of those inherent limitations we talked about, management override, human error, collusion, You can never rely 100% on internal controls. Substantive procedures, those direct tests of balances and transactions, are that final essential layer of direct verification, the ultimate safety net.
Okay, that's super clear. So let's put the entire audit risk equation and the steps auditors take into a concise summary, maybe thinking from a planning perspective.
Okay, the full equation. AR equals IRX, CRX, DR. And the typical steps in planning are pretty systematic.
Step one.
Step 1. Determine audit risk, AR, usually set low by the audit firm itself. They want a very low risk of issuing the wrong opinion, often just assumed low in practice.
Okay, set AR low. Step two.
Step 2. Assess inherent risk, IR, based on understanding the client business, industry, accounts. High IR means accounts are likely misstated. Low IR means less likely, often qualitative judgment.
Assess IR. Step three.
Step 3. Assess control risk,
KISS CR.
based on understanding the client's internal control design, implementation, maybe testing effectiveness. Big point. If CR is assessed high, weak controls, or no testing, then RMM equals IR. If CR is below high, controls must be tested to prove they work.
Assess CR linked to RMM. Step 4.
Step 4. Determine detection risk, DR. This is the final controllable planning step. Based on the assessed IR and CR, which give you RMM, the auditor figures out the acceptable DR. Remembering that inverse relationship. High RMM means low DR is needed. Low RMM allows higher DR.
And that DIR drives the actual work.
Exactly. That determination of acceptable DR directly drives the nature, extent, and timing of the detailed substantive audit procedures.
So we've laid out the framework beautifully. Now let's try a concrete example to really see this in action. Imagine Katie is auditing Sweet Strawberries, a fictional company.
Okay, sweet strawberries.
And she's focusing on their investment account. This company uses highly complex derivative transactions, notoriously tricky.
Derivatives are tough.
And Katie has tested Sweet Strawberries' internal controls for these derivatives and found they were not operating effectively. What should Katie do? Walk us through her thought process using the model.
Perfect scenario. Let's break down Katie's thinking. First, inherent risk, IR, for that investment account. Complex derivatives, that screams high risk. They're hard to value, involve assumptions, volatile, built-in susceptibility. So Katie assesses IR as high.
Okay, IR is high. Next.
Control risk, CR.
Right.
Katie tested the controls, found they are not operating effectively, direct evidence the company's safeguards aren't working here. So Katie assesses CR as high.
CR is high too, so RMM.
Now, risk of material misstatement, RMM. Since both IR and CR are high, the overall RMM for this investment account is high. Remember, when CR is high, RMM effectively equals IR, which is high here.
High RMM. Got it. So finally DR.
Finally, detection risk,
Yeah.
Katie's control over. Inverse relationship time. Because RMM is high chance the account already has a material misstatement, Katie must accept only a low detection risk. Non-negotiable.
She has to be really sure she finds any errors.
Exactly. Her own audit procedures must be exceptionally effective and exhaustive to catch misstatements that are very likely lurking in this high-risk account.
So what does that actually mean for Katie's audit work? What procedures does she need to beef up or change to get that low DDR?
Excellent question. This is where theory hits the field. Since the account is highly likely to be materially misstated, Katie needs more persuasive and reliable evidence. This impacts nature, extent, timing.
Okay.
She should consider testing closer to year-end, maybe at year-end. Derivative values change fast. Testing it to Gale 31st gives the most relevant evidence.
Right, timing. What else?
She'll need to significantly increase her sample size, look at way more derivative transactions, maybe even all the significant ones, more extent.
Okay.
And she'll prioritize obtaining more reliable evidence. Nature changes here. Move beyond internal records, get direct confirmations from brokers or financial institutions holding the derivatives.
External.
Yes. Maybe even bring in a specialist to independently value complex ones. Third-party evidence is much stronger. This whole comprehensive approach is needed to hit that low DR target.
That's a really clear step-by-step application. And that leads us perfectly to another passkey insight, right? The direct relationship between RMM and the substantive procedures.
Exactly. While RMM and DR have an inverse relationship, RMM and the assurance required from substantive procedures have a clear, direct relationship. Meaning, higher RMM, more risk in the client's books, requires more assurance from the auditor's own direct tests.
Yeah.
More persuasive evidence, larger sample sizes, maybe shifting timing to year-end. Higher risk demands more auditor work. That's the so what for the auditor's daily grind.
It drives the work plan. Got it. So it's clear now that audit risk and materiality are incredibly intertwined. How do they work together in the grand scheme, influencing the whole audit?
They're absolutely inseparable, considered together at almost every stage. They guide the design nature, extent, timing of procedures, and also the evaluation of the results, guiding principles throughout.
And what influences how an auditor thinks about them?
Various factors. The entity's size and complexity, a small local shop versus a global giant, have vastly different risk and materiality levels.
Sure.
The auditor's professional judgment is huge. Their experience, knowledge of the client, its industry, its controls,
And the users matter too. Investors, creditors.
a very significant role. The auditor must consider the needs and perspectives of financial statement users when deciding what's material. What would matter to an investor? What would a lender care about? That guides the materiality threshold.
And they think about this at different levels.
Yes, two crucial levels: the overall financial statement level, the big picture,
Yeah.
and the individual account balance, transaction class, or disclosure level, the details.
What's the difference between something being significant versus material? They sound similar.
Great question. Common confusion. They're related but distinct in auditing terms. An item is significant when there's an identified risk of material misstatement at the assertion level. It means the auditor flagged it as potentially vulnerable, needing focus.
Okay. Risk-focused?
Yeah.
Material.
Material is when there's a substantial likelihood that omitting or misstating it would influence a reasonable user's judgment. So, significant relates to where the risk might be. Material relates to the impact on decisions.
Can you give an example?
Sure, a small, unusual transaction might be significant because it's risky and needs extra checks, but the error itself might not be big enough to be material to the overall financials. But if an error relates to the company's entire revenue system, it's likely both significant and material.
Okay. And if something is material but wasn't flagged as significant?
That's a red flag for the auditor themselves. It suggests they might have missed something in their risk assessment and need to revisit it.
And there's an inverse relationship between audit risk and materiality, too. These inverse relationships keep popping up.
Indeed there is, though it's often nuanced. The source says the risk of a very large misstatement may be low, whereas the risk of a small misstatement may be high.
Big errors might be rare, small ones common.
Kind of, but the key insight here is, the more material a misstatement is, the less likely it is to be missed by the auditor.
Why is that?
Because auditors inherently focus more heavily, with more robust procedures, on highly material items. A $10 million error is far less likely to slip through than a $10,000 error because of the increased rigor, sample sizes, and attention paid to high-impact areas.
So they put more effort where the potential impact is biggest.
Exactly. This inverse relationship reflects that strategic allocation of audit resources.
Well, okay. That was a truly comprehensive deep dive into audit risk. We've really dissected what it is, explored IR, CR, DR, seen how they fit in the audit risk model.
AR, IRX, CRX, DR.
Right. And understood how auditors use this systematic approach to manage all that uncertainty in financial reporting. It's definitely more strategic than just checking numbers.
It truly is. It's a sophisticated way to manage the complexity of ensuring financial truth. We've hopefully, pulled back the curtain a bit, offered you a shortcut to understanding how financial trust isn't just assumed, but actively built through careful risk assessment and targeted work.
So understanding audit risk isn't just for accountants then. It's really about recognizing the layers of trust, verification, and the inherent limitations in any system where information is critical. It really makes you think, doesn't it?
Indeed it does. And if we connect this to the bigger picture, it raises an interesting question for you to consider.
Okay.
What might be the everyday implications of these concepts, even beyond financial statements? When you rely on information, assessments, how might this understanding that even good systems have risks, that trust is built on reasonable assurance, not absolute certainty, shape your own approach to evaluating claims or data in your personal or professional life?
That's a fantastic thought to mull over, a great way to carry this knowledge forward. Until next time, keep digging deeper.